From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, November 1st, and you're listening to the HPS Macrocast. I'm Tony Fratto, coming to you from New York City. We have the rest of the team, my partner, Matt McDonald, at HPS headquarters in Washington, D.C., along with John Fagan and Brendan Walsh from Markets Policy Partners. Guys, it was Halloween last night. We're gonna get the Halloween cliches out of the way. Like they can run through the show, but I'll start with them. I'll get them early. You know, it was Halloween last night. There was some suspicion that the jobs report this morning would be spooky.
There was whispers that it could be negative. Yeah.
Yeah, I mean, people pointing to the GM strike and other reasons, and in fact, other data and signals that we saw. Turns out it was there are lots of families waking up with a sugar high this morning. President Trump woke up with a sugar high this morning too, because he got a pretty good jobs report after whacking Jay Powell yesterday. He got a good report. So, but it was a pretty solid report and great revisions. Matt, you have the numbers?
I do. Yeah. It was a very solid report. So the top line non-farm payroll rose by 128,000 in October. It's also notable that revisions were strong. So August and September went up almost 100,000 in addition to the numbers for October. The unemployment rate ticked up a notch, so it went from 3.5 to 3.6. But
that was actually 3.56%.
Yeah,
so
it's not
as close to being revised, rounded up.
The margins are very tight on that one, and
just amazing how strong it is.
And it was driven in the household report by increases in the labor force. So that's on net good. There was a BLS actually had a note that I thought was interesting, is that they said among marginally attached to the workforce, so people not currently looking for work because they don't think they can get a job, those numbers over the past year went down from 341,000 last October to 165,000 now.
Yeah, it's a great forward-looking indicator.
That is a sign of a very strong jobs market. And then likewise, when you dig in on some of the other factors that you see, is that the average hourly earnings increased by 3% over the past 12 months. We continue to see strong growth on the earnings side. So you add that to kind of expectations around the GM strike and all the rest of it, and in these kind of mid 100,000 ranges, that's about what the growth of the labor force can be. This is a really strong report.
They called it out. So it was 42,000 declined because of the GM. So this number was really like 170,000.
Yeah, which at this point in the business cycle is super strong.
Pretty amazing, yeah. I guess a 3-month average is 176,000, which is it's really above where you would think at this point we would be.
And we're seeing,
we're
seeing the wage pressure.
Right, exactly.
Yeah, which is in particular. I mean, I saw some of the data on, on that sort of core adult population, 25 to 54, where the employment population ratio is up at over 80% now, around 80.3%. That's a high that we last saw back in, I want to say 2006, 2007. It's not quite as high as what it got to in 2000, which was around 82%.
Right,
but high.
When you adjust for demographics, we're basically we're back to the highs.
Exactly, it's that kind of peak, and wage growth in that group is at around 4% annualized. So that's those are real and solid and important. And what it says is, you have to assume the consumer is going to continue to be pretty strong.
Right, and we saw that in the third quarter GDP report, which that 1.9% was what the economy grew, but it was entirely basically driven by consumption, where actually business investment was a little weak, which is somewhat surprising. But with the trade war going on, I suppose it's to be expected a bit.
The business investment, I mean, you have to kind of look at it. There's no question it's weak, and Chairman Powell cited it in his statement, and the FOMC statement, and the press conference talked about it a little bit. I mean, you look at some of the categories. Certainly, non-residential fixed structures is weak.
Yep.
Mining, and oil, petroleum is really, really, really weak. And R&D and some other technology investment is doing okay, but so it's in those areas. The fixed structures, I think it really is worrying. If you look at the forward signals in the past from a weakening of business investment, it's definitely a worrying sign for the economy. But but it's hard to look. I mean, it's hard to argue with this level of job creation sustained. Look, we're off at the I think in 2018. Average monthly payrolls were around 225,000 a month, and so this year 2019
to date, it's 167, and it was 223.
167. Okay, so so it's off of those highs, but like you guys said earlier, it ought to be, and it's like it can't go on forever at those at that fast a rate.
The markets are now so used to seeing strong labor market data at this point. It just seems as though there's plenty of give and take in other economic data. We'll talk a little bit about that in a minute. But the labor market has just seemed bulletproof again and again, month after month, and consequently, the equity market loves it because it's it shaves a little bit of the growth concerns potentially, and and brightens the consumer picture. But the dollar isn't really doing much of anything. Treasury yields aren't doing much of anything. Typically, both of those would rise on a number like this, and they're just shrugging it off. It's part of that is, as I said, the labor market has been really consistent, and another part of that lack of reaction in financial markets is the fact that the Fed has really downplayed the importance of these labor market numbers in its decision making. And we'll talk again. We'll talk a little bit more about that later.
Now's probably a good time to do it, where you have an incredibly strong consumer, you have a strong job market, you have a weak manufacturing. So we saw the Chicago PMI yesterday, which was quite weak, and then as we talked about the GDP number, which strong consumer but weak business investment. And that has resulted in the Fed cutting 3 times. So we got a cut on Wednesday. Now here we are, and the Fed the Fed is hoping to be able to pause. We'll see if the market allows it to. But certainly you have the combination of three cuts, but then also the Fed is buying $60 billion worth of treasuries a month up until, well, it could be longer, but they're planning on doing it through halfway through 2020. They're doing this for the purposes of adding reserves to the system because of the liquidity constraints at the front end. But the reality is, in the end, you're still buying treasuries, which is crowding out the market. It has the same effect as QE, while the intention is different. The end result also crowds out the market. So you've had and you also had every other central bank in the world cutting. So in the course of 2020, you've had a pretty good economy. And you've also had a massive amount of easing. So 2020 could be off to the races.
Yeah. Well, what's weird? What's weird about the context for both, I think, businesses and the Fed in this is that if you took the snapshot of where the economy is and you said, hey, we're 5 years deep in a growth cycle, people would be like, awesome.
Yeah.
Let's roll. The fact that we are 10 years deep just adds that pause for everybody in the back of everybody's mind is how long can this go? Yeah. And that is, I think, the big variable and the factor in all this stuff. You look at the jobs numbers today, these are phenomenal numbers.
Yeah.
And GDP looks good. It's just kind of that little needle in the back of everybody's head.
And I'm amazed how many people talk about recession. Even you follow the Google searches, in the last couple of months, recession has been one of the biggest. But
and the more they talk about it, the more likely it is to happen.
Exactly. Yeah. Well, okay, what do you think about the Fed?
Can I look for the dark cloud behind the silver lining?
Yes.
In front of the.
That's what I was just going to ask.
Yeah. So dark clouds are. We have to remember that we're running $1 trillion deficits, right? Like, so not only do we have monetary accommodation, we still have. And people keep talking about the tax cuts, the stimulus from the tax cuts running out, but you're running $1 trillion deficit and you have the Fed, with the policy rate under 2. Those are levels that you see consistent with fighting a recession. So maybe we anticipated the recession, right? And maybe the monetary and fiscal stimulus, which is what we've had for the past 2 years, still even when the Fed was dealing with the runoff and the Fed was in a quarter point rates, we still have to remember that the levels are so low. Interest costs are not a drag on the economy and haven't been for a decade.
I agree. And this brings up a question that I want to ask you, because down here in D.C. this week, the 50 and 100-year bond it has been floated again. And it seems because the administration is worried about
soon.
I know. But to your point, it seems like the reason it's being floated is because the administration is starting to get worried about funding these deficits. But what does that mean, a 50-year bond? Well, how would that affect the deficit and the funding market?
So here's the deal: is that they've got so they're looking at those numbers. I think it was like maybe $13 billion shy of $1 trillion deficit this year. There's no end in sight. Yeah, so we're going to round that up. We're looking at $1 trillion deficits for a very long time, and they're looking at their current supply, right? The products. So think of Treasury as a marketer. They are a marketer of treasuries. They've got their product is debt. They sell debt, and they're looking at the classes they have, and they've got a lot on the short end. Everything up to up to 2 years. They've got 5 years out there. They're issuing a lot of 10 years. They've had to issue more. They've had to issue because the deficits are so high that they have to finance. They've put more into the 30s, but it's not obvious to me out there that there's huge demand for a different asset class. But they're scrambling, just trying to find new products to put out there to be able to drive demand. And so look, there are negative effects for that. It's going to increase borrowing costs to go more on the long end. The long end is more expensive, but they're trying to figure out where they can keep creating products for the market. But it's not. The question is is the supply of a new kind of a new maturity asset going to drive more people into treasuries? And I just look at it and say, I don't know why, if you're buying 30s, and not many people are, but if you're buying 30s, what would inspire you to buy a 50? Like what's the attractiveness? What's the advantage on a 50 that you're not getting on a 30? Because they're both really long. Yeah,
because you're basically talking about life insurance and pension funds. That's kind of who lives in the 30 range, right?
Yeah, exactly.
And that's the message whenever, and this is something, the 50 and even 100, the debate about a 50 and even 100-year bond is something that isn't novel. This has come, as we've mentioned in previous podcasts, this has come up a number of different times. It was considered during the Obama administration as well. And usually it runs into a wall of indifference or sort of tepid interest from the dealers and from the Treasury Borrowing Advisory Committee and so forth. It's not something that there's a lot of enthusiasm for, and it usually goes into these discussion periods and kind of quietly gets put back on the shelf. And I think just flashing back to during the Obama administration, just the last point is when this came up during the Obama administration, there was a sense that, well, we've got to lock in these incredibly low interest rates. We've got to take advantage of this. And that was when the mindset was that interest rates were going to go back to normal, right? The Fed was going to normalize interest rates. We were going to go back into a world where sort of, 5% was, what we might expect for the 10-year yield and so forth. And so locking in these ultra low interest rates now, the sense that we're going back to where we were in previous decades and those levels of interest rates, that has kind of eroded. It's gone away. There was a sense that we hit 2.5%, and that's maybe the new high watermark for Fed policy rates.
Now we have a president that's upset that it's not negative.
Right.
Yeah.
And Fed Chair Powell in his press conference said basically that they weren't going to be looking to hike interest rates unless there was a really significant increase in inflation. And that's not in anybody's near-term outlook. That is over a very, very distant horizon. So the idea of we've got to lock these low rates in now, I think that's a tougher argument to make.
Let's come back. Let's take a break here, and let's come back and talk a little bit more about the Fed and Powell and just where we think they are and where they're going. You're listening to the HPS Macrocast, and we'll be right back.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The Microsoft News Civic Science Economic Sentiment Index, powered by HPS, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through HamiltonPlaceStrategies.com.
Okay, we're back on the Macrocast. Guys, we started talking about the Fed in that segment and inflation and where it's going. Brendan, PCE is their preferred metric. We may want to talk about like the Dallas Fed, rate, which I have fun with too. But talk to us about where PCE is right now.
So we actually got the September. So it went from the core PCE is the measurement that the Fed pays the closest attention to, and that strips out energy and food, which are kind of the more volatile ones. So they try to target about 2%, it's exactly 2%. It decreased on a year-over-year basis from 1.8% to 1.7%. But even more importantly, basically over the course of the last 20 years, we've never really quite got to 2%. We live in this 1.5% to 2% zone. So it was quite dovish, Chairman Powell's comment that it would take significant increases in inflation for them to start hiking again. Because kind of the way that it's computed is you basically have a third of the components that are kind of technology-driven deflation. And I don't see any reason why that's going to change anytime soon. And then you basically kind of have services. And within the services, you have housing, which is a large component, which obviously we want housing to go up. But then you have the other major component, which is medical care cost. So for the Fed to significantly increase inflation in this world, in the way we compute it, you almost basically have to create medical care inflation, which I'm not sure that's a wise policy.
Yeah, when the markets heard Chair Powell's statement on what would trigger an interest rate increase and keying it off of significant inflation increases, what the market heard was, we are never, ever, 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 ever hiking rates ever again, ever.
Yeah. So while I think he'll be able to get away with pausing and not having to cut again, the market kind of knows, okay, you're a dove, you have our back. If things turn down, you'll cut again.
Yeah, he sent that signal. But look, essentially what he said is, it is gold. Not quite Goldilocks, right?
Pretty close.
But pretty close. Things are just about right. Inflation's not quite where we want it to be. So, we want to get it there. But jobs, jobs are good. Growth is, where it ought to be. And, I mentioned business fixed investment, business investment down, is weak. But you're not every metric is going to be there.
Right.
I think the market, right. It's not forever. It is data dependent. We'll see what comes next. But I thought,
and then it looks like we're going to get a deal with China. So it won't totally take away the drag away. But what do you think on that?
Who knows? The Chinese are saying, Chinese indicated this week that. And sent signals that maybe you're not going to be able to get the phase one deal. And look, we didn't talk about this, but the APEC summit in Chile, where Xi and Trump were supposed to sit down and put ink to paper on the phase one deal, is actually not happening. So they're actually the expectation was that action forcing event would mean that the phase one deal would get done, which is, and by the way, like they've, I think both sides have, taken some ambition out of what even the phase one deal would look like. So it's not clear that we get to mid-November with that thing taken off the table. I still think we're in a place where it probably doesn't get worse, and I think my base expectation is that we don't see the December tariffs go into effect, because they'll keep talking, and nobody really wants to see that happen. But I don't think things. I don't think a deal. I mean, to me, it's a toss up, right? Like whether a deal gets done or not before the end of the year.
But if a deal did get done, do you think we just keep the tariffs where they are, or do you think we're going to remove the tariffs?
Yeah, I think the tariffs stay.
Yeah.
I don't think
that seems to be the best case of what they're talking about. It would create. You'd need a much bigger deal to remove the tariffs, I suppose.
To me, putting these tariffs in place was a pretty significant, hurdle. Not just for the Trump administration. Even if Trump loses next year to a Democrat, the price for lowering the tariffs, as long as the economy's doing well, if
though I did see yesterday, farm defaults are up 26%.
Yeah, so that's a real thing. So retaliation is a real thing. And there's another data point rolling around out there that 40% of all farm profits this year are coming from either stimulus or from the
that's a fascinating data point.
The payoff, 40%. Right, is basically government is creating profit for 40% of all agriculture products. So that's probably not sustainable, but it's hard to see much the price for this administration to lower tariffs. I think is going to be really high, because as Trump has said over and over and over and over again, he's a tariff man and he likes it and he thinks it has other benefits.
That's true, but there's a sense watching the way the White House is operating at the moment with regards to the China deal and the China negotiations. There's a sense in the markets that perhaps the White House has absorbed the information that basically threatening tariffs, this pressure tactic of getting the Chinese to agree to more and more, or will hike tariffs on another round of Chinese goods on this particular day. That may be more of a 2019 thing than a 2020 thing. And the fact that the low enthusiasm apparently for putting tariffs on Chinese, more consumer-facing goods, that December 15th tranche of potential tariffs that's still potentially out there. But the sense is that maybe this kind of tactic has played itself out. And for phase 2 and phase 3, these more substantive issues, this could be in 2020, when the political calendar is really going to be driving the bus in terms of what the Trump administration is focused on. Perhaps the phase 2 and phase 3 involve less sort of volatility, and
but that's an interesting point.
And I'd be quiet
curious,
negotiations.
Matt and Tony's take. Kind of combining economics with politics, so we get state level unemployment rates, and there's basically only 5 states where unemployment has been going up, and they're in swing states. It's Wisconsin, it's also Minnesota, and then some of the South. So do you think that it seems to be that the tariffs are taking a toll on those? Do you think he then kind of pivots to, okay, I'm running for president, so now, while I said I'm a tariff man and that, but the pain that's being inflicted by him is too much to get reelected?
Yeah, I mean, the people forget, but a presidential campaign is 50 state elections.
Yes.
That's what it is. So
it's a great point.
Yeah, it's hard to say. I would say it's hard to say at this point before we even have a nominee and there's more economic, issues to be settled before we kind of settle into that zone. But yeah, they should 100% be both concerned and looking at a state by state view of. And the other thing is that the U.S. is an impressive economy in part because it is so huge, so diverse, and has so many different dimensions. But when you get down to regional drivers, is that, listen, finance in New York, energy down in Texas. Yep. Like, you know, there are a lot of regional impacts of different industries. And when you have ag impact like we're talking about, that has an impact in certain regions disproportionate to other places. And those regional ebbs and flows of the economy especially matter when you have, I mean, the whole, you know, the electoral college is designed so that the person who wins cannot have a regional base.
Right. Yeah.
That's the design. Yeah. And, you know, if Trump and his campaign would ignore that dimension at their peril.
Hey guys, I want to continue that conversation, and I also want to throw in the mix of the ISM manufacturing number that just hit, and which I think will have some influence on what Matt was just describing. Why don't we take a break and we'll come back with that data and maybe look ahead to what we're going to see next week. You're listening to the HPS Macrocast.
On the first Friday of every month, HBS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
All right, back on the Macrocast. So ISM sentiment just hit, and it shows that we're still in contraction territory. The number comes in at 48.3%. Anything below 50% says these guys are not expecting to be investing in growth and not expecting manufacturing growth. That was, better than the 47.8 we saw in September, but worse than expectations. So there's some disappointment in that number. How do you guys see it?
It kind of goes back to the point we were making earlier, where the consumer is doing well, and the manufacturing and kind of the business investment side of the economy is kind of in doldrums a bit.
Yeah, and as long as it doesn't spill over into services and consumer confidence and the broader U.S. economy, then markets are perfectly happy with this current equilibrium. But that's where they're watching very closely. So next week, that's where we're going to be seeing service. Right. Yeah.
And also, there's two measurements of the ISM, but then the market also has a host of manufacturing purchasing managers index, and that one for the U.S. is actually above 50. So I think that the market is maybe discounting the ISM a little bit, that it's overstating how bad the manufacturing center is.
Mm-hmm. Yeah, and it's a 1 month reading, but does it sustained? A sustained ISM in contractionary territory. I mean, do you guys see evidence that has played out in actual economic activity in the past?
Well, next week's service purchasing managers indexes those are going to be very interesting, and we've seen a little bit of softening in the global service PMIs over the last couple of months. And if this surprises to the downside next week broadly, U.S., China, so forth, and it really looks as though the manufacturing weakness is bleeding over into the services sector.
So the services were in the high 50s, that's a very, very strong reading. And the U.S., but also globally, it's kind of been inching down over the course of the last 6 months to like the 52, 53 range. If you're in contraction there, that's very, very, very troubling.
This is also for, tying it back to the discussion we had just before the break on the political side, is that this has an impact on the states that delivered Trump the presidency last time around. And there's a weird dimension to some of this of it's kind of hard to tell exactly what's going on, because in political polling, economic sentiment has moved to completely align with the party that's in power. So you don't, on some level, you don't really know. Like, we can look at some of this stuff, and in theory, if we're seeing weakened economic performance in Trump states or Trump communities, they might say that the economy is good, but they're saying that because Trump is in the White House, not because of the economy is good. And then on the reverse is that the places that are actually performing very well are saying it's bad,
but it's
even though it's good
there. Yeah. Well, we saw that there's a Trump tweet for everything. The GDP was 1.9%, which he said was the greatest economy in the world. But there was one from 4 years ago that when Obama was president, that we were going into recession.
At exactly 1.9%. It was the same. But he also, I didn't want to get into it this morning because it's just like, it's just goofy. But the president tweeted, and the White House is defending this bizarre number of that the job creation this month was actually 303,000 jobs. And I hesitate to even say it because it's a bunch of it's one thing if you add up. You can't even add these numbers. The numbers that he's trying to add are they're two different categories of things. Yeah, with different dynamics around them, and I don't know who at the White House thinks that you can add up the numbers the way they're adding them up, and then give it to, the president of the United States and say it's okay to tweet this out. It's just bonkers, and so I'm not going to talk about that number, but but no one should have to try to make up things about these numbers. These are really, really good numbers, and there's no reason to be whacking Jay Powell about what the way things are going too. Jay Powell seems to be doing things that are allowing an economy to still go out there and create substantial jobs and even some wage gains.
Well,
so
that's the ultimate irony is Powell's been Trump's guy. He's done everything that Trump would have wanted him to do, but he still gets vilified on Twitter.
Yeah. All right. Well, that was definitely a busy macro week. We didn't get a chance to get into things like earnings and things like that. So we have other things to look forward to next week, but not a lot of data, Brendan.
No, it's kind of quiet. We get a couple of Chinese PMIs. We'll get a sense of how the Chinese economy is holding up under the trade war, and then also some balance of trade data with both the U.S. and China. So that's become a more important data point now because of the political implications due to the trade and tariffs. And that's about it. The Bank of England also has a meeting, but there's very little expectation that they'll do anything because Brexit is still not done.
It's never going to be done. But this show is done for today. The Macrocast is done. Terrific week. Lots of stuff. Lots of data to think through. Thanks for joining us. We'll be back next week. Have a great weekend.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.